you couldn't have been watching the markets for the last year and a half or last 6 months and not realize that anybody who would invest in oil has got to be the dumbest guy alive. Tesla is and Elon Musk are the toast of the town. Everything green is going up, and peak oil is suddenly upon us, right? I mean, that is the truth that everyone thinks is happening right now. It's all you hear about. You hear about green this, green that, windmills, hydrogen, solar, all of that, and electric cars, and that's where all the money's being made, right? Well, let me tell you something. I've heard it before. I've heard it a million times before. The most recently, I've heard it 2008 when Obama came in, and everything in oil was going to be decimated, never to come back, and never to see a good price again. In 2014, when the shale players overproduced and oil prices collapsed, oil was through. We'd never see it again. And then most recently last year during the pandemic, when we saw prices not only go low, but actually go for a day below zero into negative numbers, and everyone was completely convinced that we're going to jump straight to solar, wind, and electric cars, and that was going to be the end of oil. But instead of that, if you see the markets, if you're looking at that orange line as opposed to the blue, that's basically the S&P versus the XLE, which is oil stocks. And as good as all this other stuff has done, oil has done far, far better. That's weird, right? Nobody expected oil to do pretty well. I mean, look, article after article that I saw, there was nothing but a remarkable rebound from a catastrophe. This is Bloomberg. Again, Bloomberg. This is Julian Lee. Irrational exuberance hits the oil market. It's gone too high, too fast. Here's IBD, Investor Business Daily. All prices look oddly familiar in the squeeze shale. In other words, oil's prices are going up, but you're going to get frustrated because they're only going to go back down again like they have in the past. IBD, here's the Guardian. Things are looking up for oil, but OPEC, just can't be convinced. They better not count their chickens too soon. As the Guardian. Here's Dan Yergin, who I must say is one of the at least one of the most important guys in the space. He's been here for a long, long time with his very impressive books, and he doesn't see oil making any reasonable move, at least until 2022. And this was actually pretty recently in December. He's pessimistic about oil. Doesn't stop there. The EIA is saying, this is our own energy administration. We're going to be near $50 for the next 2 years. I tell you, it's just an article and article and article after all, and of why this stuff, even OPEC is not particularly happy with the way that growth is going to go for demand. And yet the stocks keep on going higher and higher in oil, and they're outdoing everything else. So why is oil rallying? Why will it continue to rally, which I think it will? I think 2021 has all the makings of the best year, one of the best years since 2003 that I have seen for the oil markets in my life. And I've been doing this for 35 years. And obviously without ignoring what's going on in the green marketplace, because there's a lot of opportunity there. How can we integrate the two of them, make money in both, and not miss either half of this kind of renaissance in energy that's going on, both in the new renewable space and in the old traditional energy space? So we got to admit that the green revolution is real. It's not like we don't believe that at some point we'll need all sustainable fuel. And we do believe that we'll ultimately all sorts of sustainable fuels. But the truth is that that's not the way energy works. Energy has always worked in the past by building on the last technology, not displacing the last technology, which is what everybody seems to have in their mind about green energy, that it's going to displace fossil fuels. You can see from this chart, which was done actually by a Chinese group, that we go through the stages where we have wood, and then we move on to coal in 1900. When we get to oil, start at the 20th century, we see that oil starts to begin to take some of the space up in terms of energy exposure. And then as we get towards 2000 and into the aughts and the 2010s, you see how natural gas becomes a greater and greater piece of the energy pie. But what you also notice from this chart is that none of these other sources actually go away. Even wood is projected to be a significant part of our energy portfolio, global energy portfolio, to 2030, 2040, even 2050. Coal going out well past that. Oil going out even further, and natural gas, of course, not even reaching its peak until the 2040s or the 2050s. That's the way that I see the world of energy. That's the way it works. You don't displace anybody. What you do is you build on it. So the idea that we're going to displace fossil fuels so quickly is silly. What we can do is we can add, in terms of the amount of renewables we can add on top of the pile, and take up the slack on new demand that's coming in and some of the old demand that's been sitting for a long time. But taking away fossil fuels at this point, impossible. Won't happen, and it won't happen for a very, very long time. So let's look at some of the reasons why oil is due to have such a great a moment here. And one of them is demand. And oil demand is said to be on its way down. We saw in that first slide I showed you, peak oil is here. That means that demand has reached its top. This is from the same article on peak oil, supposedly proving peak oil. And you can see from here, there are four of probably the most intelligent predictors of oil use, oil demand in the world: Rystad Energy, Bloomberg, Wood Mackenzie, and OPEC themselves. And even in the most pessimistic of demand, we see that Rystad, this dip down here obviously represents the pandemic, but they see a steep rise again in demand, going to the point where we don't really reach our peak until 2028. And that's the most pessimistic of the outlooks for demand going forward. Bloomberg doesn't have a peak until 2035, as does Wood Mackenzie, and OPEC is a little more optimistic. They don't see the peak coming until 2040. Folks, we're not looking to stand in here and watch oil go up for the next 15 years, no matter whatever Bloomberg or OPEC, or 20 years like OPEC says. All we need are the next two. And if we do see this kind of increase in demand that we've seen throughout the history of oil, after this pandemic, we're going to have a tremendous renaissance in terms of price. And here's the reason why. We've talked about demand. We know that demand is going to come back, or at least everybody seems to think demand's going to come back. Now we've got to talk about supply, and supply is where the difficulties are. Now I'm going to point to you to, unfortunately, I'm not going to take a lot of time to show you why some of these supply issues have come into the market over the course of the last 4 or 5 years, but I'm going to point you to at least one or two of my books. I hate to pump them, but the truth is that you've had 4 years of disaster for the shale market. 4 years of bankruptcies, 4 years of consolidations, 4 years of negative cash flows, and the point is that we're at the level now where shale producers can no longer increase production the way they have since the last bust, which was in 2018. So they've gone through 2 times where they've had these busts in prices, and as soon as prices have recovered, they've increased the amount of production that they put into the marketplace. But now we've had these kinds of free cash flow, these negative free cash flows that have been going on for 10 years, and they're out of money, they're out of capital, they're out of credit, so they can't borrow anymore, and no one will touch them in the investment pool. And for all those reasons, they can no longer increase production, even when the price of oil comes back. They have to try and build some cash flow so that they can retire some of the debt that they have, because the next step down for them is bankruptcy. And even without this, we've seen a ton of bankruptcies. We've seen, for example, here's the bankruptcy boom for the last 5 years. And the reason I take the last 5 years is because that first bust came in 2014. So we started seeing the bankruptcies begin. 2015, 2016. Prices recovered in 2017, and there were less bankruptcies. 2018, 2019. Then it fell out of bed again in 2020 with the coronavirus. And this has been like the last straw for most of the oil producers. There's been more than 500 bankruptcies in the space, as you can tell from this chart. And what's left is that we've weeded out those weak shale players in the shale space. They are not around to push production when prices come back. And in fact, what you have is a ton of consolidations from those those players that, for example, have done some work and consolidated some of their. So I give you one of these. Here's Chevron on Noble Energy, and we've seen a ton of others in terms of bankruptcies, and also a ton of consolidations like this. Even Exxon spoke with Chevron last year about combining together. Now, it didn't come together, but if you can see those two majors actually thinking about a consolidation here, we really know that the industry is getting lean and mean and more disciplined, and they will control their production in terms of when prices come back, and they are going to look for cash flow and return on capital for their shareholders, as opposed to all the mistakes that they made so many times before. Shale is going to be the important place. And the reason that shale is the important place, as I said in my books, I'm not going to go through it, but the truth is that this is where all the swing barrels are now. In other words, all the barrels that can cause gluts into a marketplace right now are here, right here in the United States. Those are the ones that caused the glut in 14. They're the ones that caused the glut in 18. And they're the ones who are going to cause the next glut if there is a next glut to come. So I'm giving you a thesis where there is not going to be a next glut to come. In fact, there's going to be, and here's, for example, a number of reasons why there'll be no drilling. Wells are now losing money. This is Sheffield, who was a major force in Pioneer, saying that he doesn't see production coming back anytime near to where it was at its peak again. Here's another piece talking about all the bankruptcies that went on. More bankruptcies going through the coronavirus. There's more, 30% going belly up at low prices. Okay. So you get the sense of what's going on in the industry. You've got big oil, for example, taking huge write-downs, which means that they are again going to look to get cash flow moving and returns on shareholder value as opposed to production. There's been a ton of, there's been a lack of new exploration for new sources, so that when the older ones start running out of oil, you're going to have a hard time replacing that with fresh oil, with new reserves. And Rystad comes up with a very, very simple thesis, which I've been agreeing with for a very long time, actually through 2018 and 2019, that when the oil market really comes back after this clearing out of the shale producers happens, and it's happening, that there really will be a supply shortfall as these demands ratchet back up to their old levels. To me, that means there's a price there that's going to streak through the excitement that you've seen at $50, and then the reasonable excitement you've seen at $60 to go $70, $80, $90. And by the spring of 2022, I think we will again see triple digits in oil. And that is a very, very, very good thing. It's the number one thing that number one reason why oil stocks right now may represent the best value in the space. Let me give you some more reasons why. We've got a lot of money coming out of the Fed, a $1.9 trillion new stimulus package that's coming out. The dollar hit. As the dollar gets hit, oil goes higher. We can see, reversion to the mean. For example, we could take a look. Well, you want to know? Let's not do that. We could look at the multiples of oil, for example, compared to everything else. And here I want to show you, for example, what it is to compare multiples and market caps. We now see that Tesla now has the same market cap as the entirety of the S&P oil sector. So there's a value inside of oil that has already kind of bleeded out of some of the hype stocks that we see, like Tesla. And again, if I put up a chart, for example, from the start of the year of even Tesla against Exxon, for example, you'd see that Exxon has done much better compared to Tesla. And I think that's going to be the nature of what we're looking for and what we're going to see throughout the rest of 2021 and into 2022. So the opportunity is huge right now. So let's talk about how we're going to play oil and how we're going to play the green stocks that are out there, because there are a lot of opportunities left in green stocks. And in essence, what I'm going to tell you is that there are two kinds of trades. Come on, let me get to my slide. Where is it? All right, we'll have to find it now. Okay, here we go. There are two types of trades that we have to look at. And this is how we're going to make our portfolio, and it's going to make it a smart portfolio to take advantage of what's going to be a great renaissance in energy. There are two types of energy trades we have to look at. First are the traditional energy trades that we're looking at, and using all the old metrics that you've all learned in the past and the ones that I followed throughout my entire career. And that, first and foremost, is about understanding where oil is going to go. Because if you understand where oil prices are going to go, you have a really good idea of where oil stocks are going to go. I've given you some idea of why I think oil prices are going to go higher, continue to go higher through the rest of this year. And I also want to impart upon you that traditional oil stocks, at least the majors, a lot of the majors are having some tremendous, still yielding tremendous dividends that are not being, you cannot capture in many other sectors of the S&P. It's another reason why we would think that traditional energy gives you a great reason to put capital. You get paid to wait, and there is a ton of alpha that is inside, potential alpha that is inside traditional energy. But I don't want to leave out the green hype stocks that we've seen. And with that, I'm not really talking about Tesla. It had its hype, but we're trying to find the new hype stocks, the ones that we can tie a thesis to. And because we can't tie a valuation to these stocks, there's nobody in the world who can tell you that Tesla is worth the $850 a share it's going. It's not. What it is it's a collector of capital for people who can't help but being involved because Elon Musk is a god, or their belief of energy or electric cars taking over the entirety of the portfolio is too much for them to not be a part of, and a whole bunch of hedge funds who really have to have a piece of Tesla just to be in the game. They can't afford not to have a piece of Tesla. So you have to find a thesis like that. It doesn't have to be a thesis based on valuation, but it has to be a thesis based on what will drive money into it. And for here, I wanted to talk about one that maybe is not getting as much hype as probably should, and that's hydrogen. It's been relatively ignored, and one of the reasons that it works so well and it melds so well with our thesis about oil is that 90%, more than 90%, but 90% of hydrogen is created by using natural gas. And that's the connection. Hydrogen itself as a fuel used in cars or used in trucks or used in any other kind of transportation or jets or whatever you want to use it in is a zero emissions fuel like electricity is. It's zero emissions, so it has that going for it. But to create it, you most of it is done by burning natural gas. The problem with burning natural gas, of course, is there are emissions attached to that, which has been slowing down the transition towards hydrogen. But the point is that if you can find some carbon capture technology and solve that problem in the way that you're trying to solve the problem of batteries with electricity, which is also a very difficult problem to solve, you're going to have a technology that I think will outdo electricity, outdo batteries, and it has great value in terms of storage potential and transport potential that just electricity just doesn't have for various numbers of reasons. And I'm not going to go into that, but believe me when I tell you, Exxon is one of the biggest at working at carbon capture, and if they manage to make some progress there, you may find like a VCR versus Betamax kind of war, where Betamax was the first out of the gate, but in the end, VCR won the war because they came across with a more viable, a better alternative to the Betamax system. So hydrogen is one of those places that I think you can find the difference between the connection between traditional fossil fuels and the green energy. I wanted to show you a couple of the insights that my service, the Energy Word, gave to subscribers. Exxon we gave out in early January. It's done rather well. Occidental, we also gave out in early January. It's done very, very well. Of the couple of green hype stocks that we've done, fuel cell, hydrogen play, we gave out a couple about a month and a half ago, and that's come back a little, but it had a tremendous 2.5x run before that. And what I've given out, basically just a week ago. It was a week and a half ago, MP Materials, which is a domestic rare earths miner, and it made a huge move up this week because there's some rumor that in fact Joe Biden isn't going to turn around and open up markets to the Chinese just because Trump had tariffs on them. And in fact, the Chinese are threatening to hold back rare earth metals, which is important for all of these green technologies. And therefore, there are domestic miners who have been hanging around at lower levels that took a shot up. Again, these are the kind of green stocks. They're speculative. And what I ask you to do, if I can go back to this last slide that I seem to have to run through every other one to get to. I won't do that this time. Let's do this one. But one of the beauty parts of this green trade is that the options on those trades are enormous. So if you can find a way to use options, and in my service I give you some help in how to do that, using options with these very speculative high beta green hype stocks is the way to go, because you can make a lot of money basically on the premium that you sell and reduce your risk, which is enormous on many of these green trades. Now I want to invite all of you, of course, to come in a little more deeply and be part of the Energy Word service. And if you subscribe in the next 2 weeks until March 1st, I have a special discount for those of you who have joined me for this webinar, $150 off on the first 6 month subscription. You can use the code is Breakout in all capital letters, BREAKOUT, Breakout. Get 150 off on the first 6 months, and the next 6 months I think are going to be monster. Go and sign up at dandicker.com. I'm going to now stop the recording, and if any of you have 1 or 2 quick questions, I will take them. Thanks for coming in for this webinar. I appreciate it, and I hope to see you as part of our subscription service. We've been having a good year so far in 21, and I don't think it's going to stop anytime soon.